Good morning and welcome to another episode of Two Grey Beards.
Good morning.
So, what happened last week, Andy? What do you think we learnt?
Well, I guess the high level thing is higher for longer looks like it's becoming more clear. The PCE data showed that we're nowhere near a turning point for the Fed, as it was stronger than expected across most measures, including the most favored measure of core PCE ex housing, core services ex housing, sorry. And then the data we got on Thursday, which was both jobs and GDP, showed that there's nothing indicative of recession in the next quarter.
Yeah, I think it's very clear from all the data that, and let's not forget the PCE is actually Jay Powell's favorite inflation metric. But apart from that, none of the real economy data that we're seeing indicates that we're anywhere close to a recession, probably not even starting next quarter. All the numbers, whether they be unemployment or GDP or whatever, they just show an economy which is very resilient, which is firing still on all cylinders. And there is absolutely no reason to change our view that we are in a higher for longer scenario.
Right. So let's
And
talk about the debt ceiling.
yeah, no, the debt ceiling is the interesting thing. I think all the headlines show that the differences have narrowed, but they still remain. There are some leaks that they are at $70 billion apart. The devil is going to be in the detail, and nothing is agreed until everything is agreed. I think the most likely outcome is that eventually we do reach an agreement, but I think it's going to take much longer than some people anticipate, simply because the X date, which people were panicking about, which they were saying is the 1st of June, is very unlikely to be the 1st of June. It's much more likely to be sometime in July.
Yeah, and the technicals on that are they get a bunch of tax receipts on June 15th, and some of these technical things called extraordinary measures allow them to issue on June 30th. So it's still hit or miss. They could run out of money before June 15th, but the leverage that the administration has is slipping, which may mean that at some point next week, this thing gets kicked down. That's admitted by the administration, and this thing gets kicked into late July. And so that's a possible outcome. Hopefully, these guys don't go to the last minute and reach an agreement this week. But in terms of what to look for next week, that's going to be an important piece of data. So what else are we looking for next week?
Well, next week, of course, we have the NFP in the US. And I think it's very unlikely that it'll show weakness because none of the unemployment data so far have shown any weakness whatsoever. In fact, all the data has surprised on the downside in unemployment. And therefore, a weak number in NFP would be a real shock. I think the data we do have, the weekly data on Thursday before the Friday NFP, but that would be a real shocker if that came in weak, and therefore NFP came in weak. I think the odds there are very much against. The other thing we do have is CPI in Europe, and rates between Europe and the US have been very much correlated for the past few weeks. That is also likely to be stronger than expected, and therefore would cement in an E move of at least 25 basis points at their next meeting. So
Sure.
that's what we have.
Sure. And when I think about the NFP non-farm payroll likely strong. So when I think about the debt ceiling negotiations, I think it's important to just say that there's two possibilities. Well, there are three, but one very unlikely possibility. One unlikely possibility is they close the government for a few weeks and reopen in late June because when they have the money, that's unlikely. And then the other two are the ones that are most likely going to happen, which is either we have a deal or we kick this thing into late July and we have to talk about it for another 6 weeks. What happens to assets if the negotiators walk away and kick it to August?
I think the initial reaction is going to be one of semi panic in equities and a basically a flight to safety into bonds, in which case the yield curve, which has been flattening all week for very good reason, because let's face it, the data has given us a very good reason to flatten the curve, because as we said earlier, it's going to be higher for longer, and therefore why own 2-year notes, at 425, 430, if you're going to be funding this at 5 and now at 5.25 for any length of time. It's not something that you'd want to do. The yield curve would definitely steepen on that, wouldn't it? Because the flight to safety would be in the shorter end, and equities would definitely fall. But I think you will probably agree with me that it's probably a buy the dip scenario.
Sure. And we'll come to that when we talk about our portfolio, but that seems to be what you should expect if the negotiators walk. Stronger front end of bond curve relative to any other part of the bond curve, and weaker equities, and more of a panic than a actual fundamentals, because just kicking it down the road doesn't mean it's not going to get done. And what about if we reach an agreement?
Right. Well, if we reach an agreement, the devil is going to be in the details. I don't know how backloaded this deal will be, and therefore how much fiscal drag there is for 2024. There's bound to be some,
Sure.
but I think that the devil is going to be in the detail of how much. I would have thought that an agreement would slowly, if not flatten the curve, then certainly not make it steepen, simply because, as we've been saying for a very long time, the Fed isn't going to move to the downside anytime soon.
Right.
And all we have done is taken out some of the cuts that we had priced in for 2023. We haven't taken out any of the cuts we priced in for 2024. So the devil will be in the detail, but I think my initial reaction before I've read the details of the deal would be basically to do nothing.
Right. I think the idea is when you've gotten to a point with the number of leaks that we've heard, things like no spending cuts on clean energy, spending increases on fossil fuels, no new taxes, 2024 and farther out cuts, not cuts, maintenance of spending. And now we're at the do those who are receiving Social Security and other safety net benefits, do they have to work harder to get those things? And so it's fairly narrow. And I think you can predict that a deal, and by the way, I also think markets are starting to predict a deal more so than they're predicting walking away. To me, it seems very innocuous short term if they receive a deal because of what's already been expected by markets
And priced in, as you
and
said.
priced in. So, yeah, so a risk off panic on a walk away that reverses, and a pretty much nothing if we get a deal because that's what's expected. That's my outlook. Any changes to our macro outlook?
No reason to change anything. All the data supports our theory about higher for longer. Absolutely no change. And in fact, I would say that while last week, at the beginning of last week, I was in the 60-40 odds of no hike in June, now I'm in a 70-30 for a hike in June, or certainly in July.
Yeah.
So I think you were right, but I think the Fed is data dependent, and we got the data, and the data says no reason to stop now.
Right. I think that's the important part. Data dependent means they are data dependent, and the data was stronger than expected. And it's possible the NFP or the CPI could get weaker, but it's unlikely on the NFP, and it's pretty unlikely on the CPI given.
And And that is why I said 70-30 odds,
Yeah.
because this will be the last NFP we see before the FOMC. And then we have one CPI very close to the date, and that's it.
To look at the financial stability mandate, that we haven't seen any bank runs, certainly, or even any bank stresses. The use of the various programs the Fed has flattened and is declining by and large. Deposit flight has slowed. So if you look at the financial stability part of the Fed's mandate, that seems, it's not going to, may not last forever, but for now, it seems, well, you should be willing to continue to test the market with additional hikes.
And these are all reasons why we are just not changing our macro outlook.
Yep. What about the portfolio? Should we make changes to the portfolio? I've been liking bonds lately, but only at
Yeah.
the very long end.
Yeah. I mean, in my trading, I've tried to buy them and haven't had huge success. But I do think that the very long end is very close to a bottom, whether it's 5 basis points away or 10 basis points away, I don't know. I think the trend is going to be one of continued flattening of the curve. I think the curve can go another 20, 30, 40, 50 basis points flatter with the long end really not moving. But what I would say is that the likelihood that long bonds do much better is not really that high because they're fighting the negativity of the curve all the time with the negative funding. And this is what people have to understand. While you have a negative curve, all bonds are for trading. And only when you have a positive curve can you be a long term owner of bonds. And that is why I still prefer VWOB because I'm not fighting the curve. I'm getting 5% coupon and I'm getting a 7% yield to maturity. And therefore, I'm not fighting the Fed and the short term rates.
Right. Yeah, I agree with you. I am looking for higher 30-year bond yields than you are. I'm a little bit more optimistic about the economy and a little bit more pessimistic about the Fed's ability to fight inflation on the margin, I guess. And so I'm looking for higher, maybe 4.25, 4.5, to test the highs of this cycle. But I also know that I want to own long-term bonds at a price. And so the question is, how do you thoughtfully, carefully, without chasing, because there's not a lot of upside, how do you thoughtfully add bonds to your long-term portfolio? That's where we're at now, I think, both of us, but it's a matter of timing and how you execute and what your expectations for the upside are. What do you think about selling put spreads?
Yeah, it's one way to express it. If you look at the yield levels, and I can put some lines on the charts of TLT for our subscribers, I think something around the 98 to 96 area is where the TLT is likely to bottom and have reactions higher. If we go through 96, it's the end of the world kind of thing. But I don't see that happening. I think selling 98 to 96 put spreads, if you can get something for them, something reasonable for them, is something that is probably attractive for the course of the next month or so. I
Right.
really don't see the long bond yields or certainly TLT going through 98. And even if I got them at 98, I wouldn't be too worried about owning them.
Right. Okay, so that sounds like a good way to say we'd like to invest in bonds, but we're not interested in owning them at current prices, but we would like to begin adding at lower prices. So that sounds good. Now, of course, the elephant in the room is the incredible rally in one stock, Nvidia, and Microsoft and Google, the most direct other AI plays, but also some pin action hitting, lifting AMD and other hardware manufacturers and some of the broader tech. I want to make sure people understand the difference between trading and investing. And listen, we missed the AI spike. Before, when we started this service, we didn't buy them. And so, you know, at the time, they look now looking backward, they look fairly good as investments. Today, they look like trades.
Sure. And now I'll be the first one to admit that I've been trading in it from the long side. And I am fairly convinced that QQQ or XLK or whatever measure you want to look at to express these trades, I think QQQ will trade 365. It closed at 348 on Friday. So you have at least another 4 or 5% of upside. But is that an investment? I mean, we've seen all this before, haven't we? All we don't know is, are we in 98 and therefore we are going to have to wait for another 2 years for 2000 to come along? Are we in 2006 and therefore we're going to have to wait another 2 years for 2008 to come along? But we do know that this kind of bubble does not last forever and eventually it's priced out. That does not mean that these stocks will not go significantly higher. And you might be talking double digit percentages. But these are all trades. They're not something that I would be comfortable owning at these prices in a long term, long only portfolio. By all means, trade them to the upside, but don't buy them and forget them because you will regret that.
Right. And so our view is this is a long only, conservative, long term portfolio that this sort of thing doesn't belong in. And, the trading a bubble there are lots of stories about the winners and the losers of those things, mostly about the winners, because the winners are the ones that survive. And there have been already great stories about winners in this particular bubble, but it is a bubble.
Yes.
And so we can only suggest, our general thought on trading is it's very, very hard to do this. And trading a bubble is even harder. And there are lots of people that are playing this bubble. You have to
All I
decide what portion of your portfolio you want to allocate to speculative behavior. We suggest it be low, but that doesn't mean you can't spend your lunch money on chasing a bubble.
Yeah, and I can just say what I'm doing in my trading. I keep on buying on every dip. I keep on buying some call spreads, and it's worked out. I've done it like, I don't know, 6, 7 times, and every one has worked. That doesn't mean it's going to continue to work. You never know where the top is because it's irrational. I just know that the way the market feels and the way the market trades, my experience tells me that we're nowhere near an end game. It gets much more volatile towards the end. We're not seeing that. We're seeing one way action. And that to me tells me that we have, quite a bit more to go.
It's
Take that for what it's worth. But, it is speculative behavior, and speculative behavior is something that should be avoided in a long term only portfolio.
this is we have common view on what it means for a long-term investor and differing views on what it means short term. Nick has a view to play it from the long side, and I have a view is I don't know. So I'm not going to play it at all.
What is interesting, I think, is how far equities are coming away from the fundamentals as a result of bonds being at 4% and what the valuations, the appropriate valuation for equities is. What are we discounting here, Andy?
Right. I posted on my Twitter account. The basic idea is that at 4%, the standard PE that one can expect at 4% is roughly 18. To get to current valuations of equities at an 18 multiple, you have to expect the next 12 months to have a $235 earnings, which means you have to compare that to what is expected in the marketplace right now. And what's expected in the marketplace is a $220 earnings. And so what's being priced is a fairly significant increase in either the multiple or the earnings expectations to get to current valuations. And so in a higher for longer world, it is possible that equities can experience higher earnings than expected. In fact, it's fairly likely that high nominal GDP will result in better earnings than expected. But at the same time, that wouldn't support a 4% bond yield. At 4.5%, assuming higher for longer pushes yields higher, more hikes, more higher long bonds, you would have to generate $250 of earnings to support equities at current prices. And that's a very aggressive earnings forecast. So that's sort of the way I think about, valuation here.
Yeah, no, it's all very expensive, but you've seen the way the market trades. As soon as these very narrow tech stocks start making a move to the upside, all the stocks that were lagging stabilize and start going higher, and that pushes those tech stocks even higher on terms of spread to the others, and therefore all the indices just move 1% within a couple of hours to the upside. And that's the way the markets trade. They don't want to give anyone free money. They make you chase. And I think that that is likely to continue for the next couple of weeks unless we have a disaster with the debt ceiling negotiations.
Sounds good. Okay, you're going to do your thing about the levels on our TLT, and
See you next week. Our portfolio last week, of course, had no changes to it. Therefore, everything is still exactly the same. The brokerage statement is updated, so you can see absolutely everything. And so is the chart pack with the levels that we mentioned in our discussions. Finally, the order for next week is to do a TLT selling a put spread, i.e. buying a bull spread. So what we are doing is we're selling a 98 put and we're buying 96 put for a total of 5 lots, i.e. 5 shares. Why 5 shares? Because if we are assigned at 98 and not exercised at 96, then we'd have an approximately 20% allocation at 98 or lower to TLT, which we think is perfectly acceptable in this environment. So you have the idea of what we're doing, and the end date is June the 23rd. So that is just past the Fed meeting. We think that the curve would flatten significantly if the Fed were to hike again. And we think that even though TLT would not be higher, it would certainly not be lower than 98. And as I said, below 96 is a disaster, and we don't know what's going on. We'd have to rethink. So 98, 96 put spread for a credit of 45. We don't think it's worth doing it much below that. The premium would be just too low and the odds not good enough. So in any case, that is our order. Everything is updated. Please download the Excel sheet and everything is there for you. Thank you very much indeed.